Let's talk about the ATO's crackdown on income splitting in trusts and proprietary limiteds. Now, on December 1, the ATO released a practical guidance explaining what they deem as high and low risk when it comes to personal services income, personal services business, and the income splitting. Now, I want to preface this by saying that the ATO are stating, and they have stated in this practical guidance, that their views on income splitting has not changed. They have always deemed this as tax avoidance, Part 4A or Part IVA. Now, nevertheless, this is something that has just been continuing on in the Australian community, and it seems to be quite a common structure. So if this is your structure, you need to take heed. You need to ensure that if you are deemed as a high risk structure, that you change your affairs before 30th of June 2027. You must reach out to your accountant, because after that date, the ATO will be going after those high risk structures. Now, the low risk ones, they want Aussies to know that they're not doing anything wrong. It is the high risk ones that are the issue. So what is not involved in this? So if your business actually sells goods, this is nothing to do with you. It does not affect you whatsoever. If you use an asset to produce income like truck, machinery, or financial asset, again, this has got nothing to do with you. This is for personal efforts, so personal services. Where the confusion has been, or the grey area with a lot of accountants, is they've incorrectly deemed a business as being a personal services business. When they actually qualify as a personal services business, they meet one of those 4 tests and they go, well, now we can do what we want with this income. We can actually attribute it or distribute it how we want to minimise tax. That's where the issue is, because that is not the case. It doesn't matter if your structure is deemed as a personal services business. It depends on where the income is derived from. Simple terms. A common structure is, say, an employee who is an IT specialist. They're earning over $200,000. They decide, they see their accountant, they want to minimise tax. They've heard that all of their employee friends are setting up a trust and proprietary limited, splitting the income with their wife who's not working, and then any of the profits are going straight to the proprietary limited at a lower tax rate, then taking that out as fully franked dividends. This is high risk. This cannot happen, because the person that is producing that personal effort, the PSI, needs to receive that income in full. This is where it needs to change. So if this is your structure or something similar, we ask you to reach out to your accountant. Go and see that practical guidance. We'll have a link on our video and our stories. Review it. It is very thorough, very good. If this is your situation, you must get this changed before 30th of June 2027.